Hi, I'm Jermaine, co-founder for this community. Today I have the pleasure of speaking with Brian Feraldi about why the stock market goes up. We're going to talk about some interesting questions about the stock market, all geared towards beginners who are trying to make their way and understand how the market works. We cover things like stock splits, stock buybacks. We talk about, some of the common mistakes that investors would make and how to overcome them. And we also break down what a stock is and give you a very simple example so you can understand it from a very basic perspective. It's going to be a great video. Brian is not a first-time guest here. I'll link his other video that we spoke about value investing a few months ago, so be sure to check that out as well. Also, I want to mention here that Brian has an upcoming book. I'm going to link that in the description. It's on pre-order right now, but feel free to check it out. I think it's going to be an interesting read, and let's just jump right in. So as a Bible-based investment community, we believe in what Deuteronomy 8:18 says. It reads, "Remember the Lord your God, for it is he who gives you the ability to produce wealth." So that's our foundation here at Learn Grow Invest. So we give everything to God as the one who makes us, be able to understand what investing is, how to invest, how to manage our money, and everything that relates to good stewardship. So I really hope you enjoyed this video. Be sure to let me know in the comments if you have any questions. So if you missed our first session, we spoke about value investing. I'm going to link that video. Be sure to check it out. But we're gonna talk to Brian today about what makes the stock market go up, and then we're gonna cover a wide range of questions that I know our audience would value. So we're just gonna jump right into it. Brian, why should the average person care about the stock market?
Well, first, Jermaine, it's awesome to be back. Good to see you, my friend. And I think that's a completely valid question. I don't know about you, but I know that when I was growing up, I always thought of the stock market as this random number generator. Essentially, the newspaper would come out and you'd see numbers go up, numbers go down, and it would be like, who cares? Like, what's the big deal, right? Why should I care about this boring thing that seems to have no impact on my life at all? Well, I think the reason that the average person should care about the stock market is that once you understand what the stock market is, you realize that it's the greatest wealth creation machine in the history of mankind. And most importantly, especially today, this amazing wealth creation machine is perfectly accessible to essentially everybody on the planet. So if you're interested in growing your wealth, building wealth over time, the stock market is one of the ways that you can do that. And I'd argue one of the best ways. Now, to throw some quick numbers out there, I'm always a sucker for tables that show little bits of money becoming big amounts of money. If somebody started their working career in the United States 40 years ago, so roughly 1981, and that person set aside $100 per week out of their paycheck and put that into the stock market, and then forgot about it, didn't pay any attention at all to it, and just invested in and earned the same returns as the US stock market over the last 40 years. Well, that $100 per week equals roughly $192,000 in total contributions, right? Just the amount that you're putting in. Well, if that money was invested in the stock market, that $192,000 would turn into $3 million, literally more than 15x the amount that that person would have contributed. And that is something that kind of power to take small, consistent amounts of money and turn it into huge amounts of money is available to everybody today, especially with technology making it so easy to get invested. So if you're interested in building wealth and funding a comfortable retirement, the stock market, I believe, is one of the best ways that you can do that.
I definitely agree with you. That's one of the ways that we've been seeking to build our wealth as well. So yeah, I agree there. So let's break it down for somebody who this may be their very first investing video. What is a stock and why are they valuable?
Yeah, this is a perplexing question, right? Like, why are these things called stocks and why do they trade on public exchanges? So let's just start there. First, it's just important to understand what is a stock. So a stock or a share simply represents fractional ownership of a corporation. Fractional ownership of a corporation. It simplifies record keeping for figuring out who owns what as part of a corporation. So Jermaine, let's just make things simple. Let's say you and I start a business together. It takes us $10,000 to get this business off the ground. We're selling cookies in our local area. You, Mr. Moneybags, have $9,000 to put into this venture. I only have $1,000 to put into this venture. So we pool our money together. We have $10,000. Well, how are we going to figure out who owns how much of the corporation? Well, this is where stocks make it really easy. So to make things easy, we would say, okay, our new corporation has 10,000 shares of stock, 10,000 equal parts, and they're worth $1 each. We just made that up, right? You contribute $9,000. You own 9,000 shares. I contribute $1,000. I own 1,000 shares. Now, of course, our cookie business is wildly successful. And in the first year, we generate $25,000 in profits. Nice. $25,000. Way to go, us. And we decide we're gonna pay that to ourselves as a dividend. So we're gonna take that $25,000 and we're gonna distribute it to the shareholders. Well, how much do each of us get? Well, this is where the simple math, this is where shares and share ownership becomes so useful. So we made $25,000. And in total, there's 10,000 shares. So quick math on that. Each share is entitled to $2.50 of profits. Now, you own 9,000 shares. So your part of that is 9,000 times $2.50. Yep. My part is 1,000 times $2.50. Now, that is a really simple example, and we could probably do the math fairly easy, but you can imagine how complex things get when there are thousands of shareholders and there are billions or millions of dollars that are invested. And some people want to invest $100 and other people are investing $10 billion. That's why shares exist. They make it so the math can be done to figure out how much of a corporation is owned.
Makes sense. I mean, I can't think of a simpler example. So yeah, that's definitely good.
Now, to answer your second question, why do they have value, right? Why do shares have value? So that's what shares are. But the reason that shares have value is because they represent a legal claim on the assets and profits of that corporation. So again, our business started out trading for $1 per share, right? We made that up. We each bought them for $1 per share. Well, in the first year of operation, that share entitled us to $2.50 of profits. So the question is that something that other people would value? Would you want to own shares in our company? Our company just created $2.50 in profit per share that we owned. Do they have value? Well, yeah, I think that something that puts $2.50 in my pocket has value. The same is true of stocks of Microsoft, of Apple, of Google, of all the companies that exist out there, because it represents a legal claim on that company's profits and that company's assets. That's where stocks derive their value from. If that company goes on to create lots of profits and its revenue grows, the value of that stock should increase. Conversely, if that company doesn't produce profits or eventually goes out of business, that stock will go towards zero and be worthless. But that legal claim on the company's profits is where stocks derive their value from.
Awesome. Great. I think that's really clear. If it's not clear for you, just let us know in the comments below and we'll I'm sure we have other videos on the topic to explain further. So Brian, how can the investor know what a company is worth?
Yeah, this is a particularly tricky tricky thing to think through. So let's start at the most basic level. So again, let's go back to our company, and let's say again our company did $2.50 in profits in its first year of operation. So what would you pay to buy that revenue stream, that profit stream of $2.50? Well, let's say you're feeling miserly and you decide I'm only going to pay $5, right? I'll buy one of your shares of stock, but I'm not willing to pay more than $5. I agree because I'm in need of cash. I sell it to you. You take my stock for $5. Well, in that first year, you paid $5 for my stock and you earned $2.50 in profits. That's a 50% return on your investment in the first year. That's fantastic, right? Could you get that by going to the bank and earning interest on it? Of course not. So $5 per share is a super cheap price, right? I would never sell it to you for $5 per share. Conversely, let's say you were feeling really, really generous and you're going to pay $250 per share for that stock. So $250 per share, and we exchange. Well, you paid $250 for the stock, and then in the first year you earn $2.50. Well, that's a 1% return on your investment. That's likely to be far too low to entice you to buy my stock. So that's how you value companies. It's based on a multiple of the company's expected profits. And the price that investors pay at any given time is, of course, dictated by the market's emotions. If markets are feeling really bullish and optimistic, the price or the value of that company goes up. If investors are feeling bearish and pessimistic, the price of that stock goes down. But broadly speaking, companies are valued on a multiple of their expected earnings.
Okay. So you mentioned two words there. I just want to help our audience understand. You mentioned bullish and bearish. Can you just give us a quick definition of those two words?
Yeah, it's a good point. Backing up. So bullish, bull market, bullish derives its is from the phrase a bull market. And a bull market is just simply when prices have risen about 20%, and the market prices are expected to continue going up. So this is a market where prices are increasing. So if you're bullish on something, that means you expect the price of that thing to increase over time. Bearish is the exact opposite. A bear market is when prices have declined, typically about 20% from their recent high, and they're expected to continue going down. So if you're bearish on an asset or a stock, that means you expect that price to fall.
Okay. All right. So, I mean, I can just imagine that person now hearing everything that we've said maybe in the last couple of minutes and saying, well, a lot of things are starting to make sense for me now, but they may have some other questions. I'll ask you, Brian, what were some of the biggest questions that you had when you just started investing?
Well, when you first dip your toes into the water, I don't know if the people listening are anything like me. I was provided with zero education about the stocks and the stock market when I was in school. And I went to university and I focused in business. And even though I focused in business, I was still taught next to nothing about stocks, the stock market, and investing. So nobody ever showed me a compound annual growth rate. Nobody ever explained to me that the stock market goes up over time, or even the fact, have you heard this one? This one perplexed me. When I'd heard about the stock market from other people or in publications, I'd heard the stock market goes up about 10% per year, right? That was the historic rate. And I would be like,
what does that mean?
What does that mean? One, what does that mean? Two, I don't understand what you're talking about. Like if I look at the stock market over the last week or month, all I see is squiggly lines, right? So it's going up, going down. So where is this magical compound 10% return that you're talking about? And all you see if you look at like the major market indices, such as the Dow Jones Industrial Average or the NASDAQ or the S&P 500, is one number. You just see a number going up and down, and you hear things like the S&P 500 is up 50 points today. It's like, all right, where is this magical 10% that come from that you're talking about? Well, only later did I learn that markets aren't measured in points. They're reported in points, but they're really measured in percentages. So real quick math, if a market index is at 1,000 and it closes the next day at 1,010, well, it went up 10 points, but measured from the total a base, it went up 1%. That's the thing that matters, the percentage. If it went up 1%, you earned a 1% return on your money. Conversely, if it declines, the percentage of the decline is what matters. So one, that's where the percentage return comes from.
Okay.
Two, the way that the markets are measured is typically tracked in matter of years. So on January 1st of any given year, the value of the S&P 500 or the Dow Jones is recorded, and that's used as a base rate. And at the end of the year, you get another number. And the difference between those two will show you the return for that given period in a percentage term. And then on the next year, the new number is used as the denominator. So markets compound because it's measured on a percentage basis annually. And if you look over long periods of time and average it all together, that's where that magical 10% per year comes from. Okay. But that just confused me. Like nobody ever explained that to me simply. But like so many things about investing, the concepts aren't difficult. What's difficult is it's never been explained.
Yeah, agreed. All right, so we're gonna talk a little bit more about some of the things that you should understand as a beginner a little bit later on. But you've been investing for a long time, Brian. So what was your experience investing through the 2008 financial crisis?
Yeah, so I first started buying and selling stocks. I wouldn't say investing. I'd say I first started buying and selling stocks in 2004 because at the time, my mindset was short-term trader, right? My mindset was I buy X stock today. I'm going to sell X stock in a week or two. I'm going to book a gain, and that's how you make money in the market. So that's not really investing. Now, I did terribly with that style of investing, so I quickly learn that the way to make money in the market is by buying and holding great companies for long periods of time. But soon after I got started with that kind of investing style, the 2008 financial crisis happened. And I vividly remember being in my car listening to the radio, and the radio would come on and they would say things like the Dow Jones Industrial Average dropped 600 points today. And Lehman Brothers went bankrupt, and people can't pay their mortgages, and the unemployment rate is skyrocketing, and bad headline after bad headline after bad headline. And I saw the savings that I had amassed at that point and that I'd put into the market just go down, 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 down. I mean, peak to trough, the major market indices between July, I'm pretty sure, July of 2007 and March of 2009, peak to trough dropped over 60%. Wow. The whole market. So you could imagine what it was like for individual stocks. They fell far more than that. Now, during that time period, I was still an active buyer of stocks, and I was putting money faithfully into the market every single month. But I'll tell you, it felt awful. Yeah. It felt awful to basically buy something one day, and then literally the next day or within a week, that thing you bought, the whole thing you put in was down 10%, like in a matter of like a days. And it just felt for over a year like I was throwing money into a money evisceration machine. And that it just feels so horrible to do so. However, I at that point was at least smart enough to know that over long periods of time, the market has always recovered historically from big drops, and it would eventually come back. And of course, now looking backwards at those purchases that I made, many of them got into great companies at stupendously low prices today. Yeah. But I can tell you at the time, it just felt awful.
Yeah, I can imagine. So, because one of the hardest things to do, and you share this on your social media all the time. You know, one of the hardest things to do as an investor is keep buying when the price is going down. So I can just imagine how that felt. So I imagine that you might have made a lot of mistakes as a new investor. What would you say are maybe your biggest mistakes?
So I have made pretty much every mistake that you can possibly make in the market, and that's just part of becoming a better investor. You know, people can teach you lessons and say things to you like don't use leverage, right? Have a long-term focus, don't focus on the share price. But some lessons just need to be learned the hard way, but firsthand. So the first mistake that I made was I thought that the way to get rich in the stock market was to day trade penny stocks, right? To focus on these garbage companies that traded at low dollar prices, and again try and flip them later that day or later that week to somebody else at a higher price. And that is an enticing way to make money in the market, because one bad thing about investing is that we get immediate feedback by looking at the price of something, right? If you buy something for a few hour stock for $5, the price is going to be different at the end of the day. Maybe it's going to be $5.20, or maybe it's going to be $4.80, but you get immediate feedback. I made money. Oh, I lost money. I made money. Oh, I lost money. So it's very enticing to say to yourself, I can go to the stock market and I can immediately make a return, because in some cases you could do just that. However, I learned the hard way. First off, I had no clue what the companies that I bought did. I could tell you nothing about the businesses other than the ticker and the dollar price per share. That's it. That was my due diligence, right? It was like, oh, this stock is trading below $5. I'm interested. End of story. That was it. So the first thing I learned is that stocks that trade below $5 tend to deserve it. That they tend to deserve it because they're just bad businesses. So I get burned very quickly by doing so. Well, my personality is, once something doesn't work, I try and take the exact opposite approach. So the next thing I tried was, all right, day trading penny stocks doesn't work, or at least I suck at it. Instead of doing that, I'm just going to go after dividends, right? I'm going to go for the exact opposite thing. A nice, safe, buy this thing, do nothing, and your bank account goes up. But yet again, I did no research. The only research I did was dividend yield. That's it, right? If a dividend yield was over 10%, I was interested. My logic being, I buy this stock and then I just hold it, and then I'm going to earn a 10% return on my money, right? I'm fine with that. I won't be greedy. I'll just take a market-beating return from the dividend. Yet again, I learned another important lesson. Dividends are not guaranteed.
There
you
go.
Only strong companies can actually afford to pay their dividends. And oftentimes, if you use screeners to find dividend yields, some of the highest yielding stocks on those screens tend to be companies that are in the most trouble. I didn't know that ahead of time, but I learned that the hard way, because many of the stocks that I bought, not only did they stop paying their dividends, but once they stopped paying their dividends, their share price tanked. So not only did I not earn the dividend, I got my capital got cut in half. So I would say those are two of the biggest mistakes I made early on, and they were just really following my natural instincts to go after making money immediately and then making money the easy way. Turns out that investing isn't easy, right? Investing is actually something that requires studying and education, and you really have to understand what you're doing before you do it. So those were two of the big mistakes that I made early on.
I completely can relate to those, especially as it relates to dividends. I thought my first year of dividend investing, I thought I could just choose like the top 10 dividend paying companies from the previous year, just put all my money there and wait. And then the end of the following year, I'm like, I didn't get what I was projecting. What happened? Or, this company announced that they're not going to pay a dividend until further notice, or the stock price just kept on going down. So I'm like, what is happening? So I can completely relate to those. So yesterday, I actually saw Google announce a stock split. That's one of the things that a lot of new investors don't understand what a stock split is. Can you explain that for us?
I didn't actually see that announcement, so that's interesting to note. Yeah, a stock split is something that markets and market participants, especially new ones, get really excited about. Like they get really excited about. But when you dig into the details of what a stock split is, it's important to understand that. So let's go back to our cookie store, Jermaine. Yeah. So we initially invested $10,000 into our cookie store at $1 per share. So we said for, completely arbitrarily, right? We're going to have 10,000 shares of stock because we invested $10,000, and those stocks are going to be worth $1 each. Yeah. Let's say we did that, and we woke up the next day and said, you know what? I want to have more shares, right? I don't want our stock to trade for $1 per share. I want our stock to trade for 10 cents per share. Well, the next day we could wake up and do a 10-for-1 stock split. And we could say, instead of there being 10,000 shares in total, we're now going to have 100,000 shares in total. But remember, we still invested $10,000 into this business. So what is the share price of each individual share worth? Well, 10 cents. 10 cents. But instead of you owning 9,000 shares, you now own 90,000 shares. But instead of them being worth $1, they're only worth 10 cents. So the number of shares outstanding went up by a factor of 10, but that means that the price had to go down by a factor of 10. So net, nothing changed. You still have $9,000 invested in the company, and I still have $1,000 invested in the company. The exact same thing happens with stocks on the public exchanges. So I didn't see how much Google is going to split their stock, but one share of
it's supposed to be a 20-to-1. I don't think it's confirmed. I think it's pending confirmation, but I believe I saw the thing being considered is a 20-to-1 split.
Sure. Okay. So right now I'm looking at Google's price. Google is trading for about $2,970 per share. On a dollar basis, that's a huge amount of money, right? If you want to become a shareholder of Google, you have to come up with $3,000 to buy one share of stock. That's a big barrier for a lot of investors to get into, especially if you're not working with a lot of money. Now, years ago, 20, 30, 40 years ago, it would have become almost impossible for a shareholder to buy Google, because you would have had to buy at least one share of stock, and more likely to get a broker to actually do it, you have to buy 100 shares of stock. So that would be, to buy 100 shares of Google would be $300,000, right? So that would just be an astronomical amount of money. Now, we're spoiled today because you can now invest in fractional shares. So instead of you needing to buy a whole share, you can buy 1/10 of a share, or a 50th of a share, or a 100th of a share. So if you wanted to invest $30 into Google today, you could do so, right? You could do so, and you would buy in. You would just buy a small fraction of a share. But essentially, at its core, that's what's going to be happening with Google. So if Google is doing a 20-for-1 stock split, let's just make the math easy and say it was $3,000. So after the stock splits happens, the number of shares in total in Google is going to go up by a factor of 20. So they're going to be 20x more shares outstanding than before the split. Conversely, the price of one share of Google stock is going to fall from $3,000 to $150, or 1/20th the price. The total amount that you have invested in Google before or after won't change. But what will change is the quoted price of Google's stock. And for some people, they have a psychologically easier time buying into Google at $150 per share than they would at $3,000 per share. So that's what's happening.
Yeah, I've always thought stock splits were very interesting, because you're right. That last piece that you said, there's something about the psychology of saying it's easier to buy something when it costs $150. It's easier for that stock price to increase when, I mean, you and I could talk about the true value of the company at that reduced price. We won't confuse any new persons right now. So in addition to a stock split, we often hear of a stock buyback. What is that?
So a stock buyback is a confusing term that gets a lot of people up in arms when they hear companies are spending money on it. But all a stock buyback is when a company chooses to repurchase or buy back its shares of stock from its investor base, and by doing so, it reduces the total number of shares that are outstanding. Again, let's make this really simple. Go back to our cookie store. So our cookie store is 10,000 shares of stock in total. You own 9,000 of them. I own 1,000 of them. If we repurchase, let's say the company decides to repurchase 1,000 shares of stock from you. Okay, the company repurchases 1,000 shares of stock from you directly. So the company gives you a bunch of money. You, in exchange, give the company 1,000 shares of stock. Well, the company takes those shares and retires them, so they're no longer active. So instead of there being 10,000 shares outstanding, there are now 9,000 shares outstanding. I still own my 1,000 shares, but your ownership went from 9,000 to 8,000 shares. So when the company makes profits, rather than dividing the total by 10,000 shares that used to exist, we're now dividing it by 9,000 shares. So the same amount of money is spread over fewer shares. That means that me, who didn't sell my stock, who still owns the stock, I own a slightly bigger piece of the total pie than I did before, simply because I didn't sell my shares back to the company. You own slightly less of the company than you did before because you did sell it back. But in doing so, you were given cash for making that transaction. So that's all a stock buyback is. If a company has 1 million shares outstanding and they choose to buy back some of those shares from their investors, that reduces the total number of shares outstanding, and that makes all the existing shareholders own slightly more of the corporation. So that's all a stock buyback is.
Okay. And so the interesting thing, so why would a company do this, right? Because I think that's a part some persons may be curious about, because there are some investors that are seemingly bullish when a company announces a share buyback. Why would that be the case?
So a stock buyback is one of two primary ways that a company can take some of their profits that they have and return it to their shareholders. So the first way, and the way that people tend to prefer, is through a dividend. A dividend is just when a company takes some of its profits or its cash and literally just pays it out to its shareholders in the form of a dividend. So to get back to our company before, our company did $2.50 in profit, and it paid out each of us $2.50 in cash for each share that we hold. So that was just cash that went right into our bank accounts. Right? I mean, that's great when a company does that. So that's one way that a company can return capital to its shareholders. The other way is through the stock buybacks. And if you are bullish on a company, in other words, if you think that that company has a bright future ahead and that company's stock price and revenue and profits are all going to rise, well, you don't want to give up your shares. But if that company buys back its stock from some of its shareholders and reduces the total number of shares that are outstanding, that makes all the remaining shareholders own slightly more of that company. So it's a way for the company to increase its stock price, at least theoretically, by using its cash that's on hand. So that's one way that a company can give capital back to its shareholders.
Okay. All right. So let's take it down to some of the more practical questions that investors might ask. So a very common question will get asked: should I buy individual stocks or should I buy a fund? Mm-hmm. What's your opinion on that?
My opinion on that is it totally depends on the person asking that question. First question I always ask anybody when they ask me that question is, well, what's your interest level in the stock market and investing? Most of the time, the answer is 0. I have 0 interest in learning about the stock market and analyzing a company. Like if that kind of thing sounds like a chore, something that you would like not look forward to doing, don't bother with individual stocks. Just take your capital, put it into broad-based funds, and kind of outsource all of that, what you're investing in, to a third party, and just make it very, very simple for yourself. There are some great investors out there, some well-known people that's what they do with their capital. They just invest in broad-based index funds. They own everything, and they don't have to think at all about analyzing a company or a competition or risks or anything like that. But if you're part of that 1 or 2% of people that actually enjoys learning about the stock market and enjoys analyzing companies, that's the kind of person I would say, okay, you're a good candidate for buying individual stocks. And the nice thing is, this isn't an all or nothing decision. In fact, one of the ways that I suggest people get into individual stocks is first by putting most of their capital into funds and having that do its thing in the background, and then layering in 1 or 2 or 3 stocks on top of that with a small amount of their capital. That way, if they make a mistake, most of their capital is just in the market, but it also gives them the ability to buy some of their favorite companies and learn how to invest.
Yep. Agreed. Okay, so let's say that you're part of that 1% who thinks that you may have the aptitude for investing yourself. How can that person go about managing their own portfolio?
By managing it, you mean what should they buy? How often? That kind of stuff. How many stocks should they own?
Just some of those. So maybe daily or monthly or quarterly decisions that you may need to make to ensure that everything is as it should be, I guess.
Yeah. So one of the tricky things about investing, and if you're going to invest in the stock market, it needs to be measured over the appropriate amount of time. So one of my favorite statistics about the U.S. stock market and the S&P 500 is that over every single 20-year period in U.S. stock market history, every single one, the stock market has earned a positive return after accounting for inflation, 100% of the time. So if you buy into the stock market today and you can hold for 20 years, the odds that you are going to make money, at least historically, are 100%. 100%. Over a 10-year period, the odds are excellent. It's about 95%. Over a 5-year period, the odds are very good. It's 80% of the time. But the shorter your time frame for holding, the worse and worse the odds get, all the way down to if you buy a stock at a given day, your odds of making money on it are about 51%. It's literally a coin flip. But the longer you hold the stock market in general, the higher your odds are of making money. So one mistake people make when they're building a portfolio or they're buying a funds is they buy and then they wait 90 days and they're like, how'd I do? Right? How did I do? They're measuring their performance over too short of a time period. And even when you're buying individual stocks, you don't really know if you've made a good decisions, sometimes for 3 or even 5 years after you've made it. So if you're going to be building a portfolio from scratch, I would say go slow. I would say start with index funds, and I would say make sure that you're only putting capital in there that you know you won't need for at least five years, and then judge yourself over 5-year periods, not 3-month periods.
Okay. All right. So, as we're gonna close out this section, I'll ask you, what is the most undervalued skill for investors to learn?
It's funny, if you're just going to be investing in index funds and doing that on a consistent basis, the most undervalued skill is not paying attention. The most undervalued skill is taking your statements when they come to you and just ignoring them. It's just not looking. and just having essentially extreme amounts of patience and telling yourself, well, I don't need this money over the next year. I'm investing for my long term, for the long term. That sounds easy, doesn't it? Sounds easy. Don't pay attention. Don't care what's happening. If you're investing in broad-based index funds for long periods of time, you can essentially ignore what's happening in the stock market. That sounds so easy to do, but the people that have the ability to actually pull that off and invest consistently for long periods of time are rare. They're rare. So I would say the biggest skill you can have is the ability to ignore whatever's happening in the short term and just focus on your long-term plan.
Agreed. I found that my most successful investments are the ones where I did the least amount of work. It's so strange, right?
Isn't that crazy?
It's so I started buying, Microsoft stock a long time ago while I was still working at the company. And I just kept buying because they allowed us to purchase through salary. And that's all I did. And for 4 years straight, I just did that. Never thought about it. Left the company years ago, but I still have the shares. And then, 2020 happened. And then it just started to go up at a really great pace. And so now I'm like, well, this is now over half of the value of my portfolio.
Wow.
Did nothing, right? So I mean, sometimes it's easier to just do nothing, right? So yeah.
Good for you. Great choice there for buying shares of that one, huh?
Yeah, I mean, so when I just started, a friend of mine, said to me, it's going to be challenging, but just buy the shares each month. Don't think about it. You'll be happy 5 years from now. I was like, what do you mean? Don't think about it. I'm saying each month. And he said, no, don't think about it. Just buy it. Especially since Microsoft allows employees to buy it at a 10% discount. So a lot of persons are tempted to just buy it at the 10% discount and sell it at the end of the quarter when it hits their account. The person's like, don't do that. Just hold it, take the dividends, reinvest it, and don't do anything with it. I'm like, that's so hard not to do anything, but I'm happy that I did that.
Who knew that doing nothing was so hard?
Exactly. So Brian, I mean, and I really encourage anybody watching this right now to follow Brian on Instagram, on Twitter, and subscribe to his newsletter. I get daily value from your content, Brian. And one of the things that I've been really looking forward to is your upcoming book. Can you tell us about that, what it's about, what type of investor should read it, etc.?
Yeah, well, thank you so much. It's been wonderful getting to connect with you as well. I absolutely love what you're doing down there. So for the last 10-ish years, I've kind of had in my mind an idea for a book or a talk or something just called "Why Does the Stock Market Go Up?" Because again, when I was a new investor in 2004, that was probably the number one question that I had about the stock market. And again, there was nowhere that I ever went to that explained that concept to me. And in 2004, when I first started investing, I read all of the classic books that you can read, right? Everything about Warren Buffett, everything by Peter Lynch, everything by Jack Bogle, everything by Jeremy Siegel, etc. And all of them point to the fact that the stock market is the greatest wealth creation machine all the time. Have a long-term mindset, buy and hold the stock market, and you'll do well. I have nothing to add to that. All of that is classic, wonderful advice, but I never found a book or came across anything that really explained just the extreme basics of what the stock market is, and importantly, why it goes up over time. Where does that mythical 10% return? What is the thing that makes stocks go up? It just never made any sense to me. Well, 2 years ago, I was talking to a friend of mine, Morgan Housel, who just wrote a book about the concept, and him and another friend of mine said, maybe you should write the book, right? I was explaining the concept to him, and I was like, all right, I guess I'm supposed to be the one that writes it. Writing a book is super painful. It took me about 18 months from start to finish to do. But that's my book is called "Why Does the Stock Market Go Up?" And all it basically is it goes through and answers all of the questions that I had about the stock market investing when I first started. So it's not about stock picking. It's not about anything complex. It is the book that I wish I could give to myself in 2004.
Great, great. I'm really looking forward to it. I checked out the page of contents, and it seems like a very interesting read. So I can't wait. So how can persons get access to the book? When will it be available?
Yep. So it's available on major publications right now. It depends on each country that people try to order from, but it's available on Amazon, and that's one of the places you can get it through many countries throughout the world. It's currently available for pre-orders, and it starts shipping the first week of April. So I am eagerly waiting for people to get into people's hands so I can get some real-world feedback on whether it's any good or not.
Okay, great. And we'll put a link to it in the description of this video, so you can go ahead, hit the link, select pre-order, and as soon as it's available to ship, you'll get a copy. So Brian, I really want to thank you for your time here again today. I feel like we can just talk about the stock market for hours. So it was a really good to have you. Any closing thoughts that you want to share with new investors?
No, thank you. Thank you so much for having. It's been a joy to watch you do great things with your channel, Jermaine. So it's awesome to see that you're continuing to grow as well. So thank you so much for having me on. I super appreciate it.
Great, thanks. Thank you for watching this video with me and Brian. Really hope you found some value in it. If you did, please remember to like this video. Subscribe if this is your first time. We post weekly content on investing, personal finance, and more. Be sure to also join our groups. We have a group on Telegram, LinkedIn, and Facebook. There we continue the discussion about the videos that we cover. So if you have any questions and you need some more details on it, join us in those groups. The conversation is is usually ongoing. So feel free to jump in, ask your questions, add to what other persons are saying, and let's just all learn, grow, and invest together.